Welcome to Truflation Spaces FOMC edition, featuring Cem Karsan, founder of Kai Volatility Advisors. Before we get started, some housekeeping notes. Truflation Spaces is brought to you by Truflation Premium, our granular data service. Indexes, Truflation Complete, and even enterprise solutions are all available. Head to truflation.com/pricing to find the plan right for you. That's truflation.com/pricing for Truflation Premium. Truflation.com is proud, really, to present today's spaces. This is day 2 of the FOMC, whereby Fed governors meet to decide what will be announced today and discussed at Chair Powell's presser. Will they raise rates? Will they hold? Will they lower? Looks like we're just now getting some of our guys in. So let me see if I can find them. Thanks again, everyone, for tuning in. We should have everybody up and rolling in just a second. Getting out all the different speakers here. Okay. And we do appreciate you hanging in there as we get this rolling here. There's always some basic hiccups in the beginning, but we will get it rolling here. Okay, so usually about this time, we do have a panel, a pretty great panel that includes, of course, Cem Karsan of Kai Volatility. But before we bring on Cem, we'll get a quick update on the Truflation take with regard to FOMC policy, and that always means throwing it to our head of product, Oliver Roost. Oliver, thanks so much, man, for coming back on. We appreciate it.
Thanks a lot for having me back on, and good to be on here.
Yeah, so let's get the Truflation look. I know you wrote up some a pretty interesting analysis that we published a few days ago. What's the Truflation take on what you think or we think will go on today?
Yeah, so look, I think other people can add their views onto this discussion, so please let us know if you have any questions. But I think it's pretty clear that the Fed, or at least the expectation is pretty clear that the Fed will hold its interest rate hike, and I think we have reached the terminal rate. I think there are a number of factors, though, that would suggest that the Fed is going to stay higher for longer, and significantly longer than we had anticipated. I think there are expectations that it starts coming down in Q1. I think you're looking at Q2 at the absolute earliest, and a number of reasons for that. Obviously we've had the recent GDP forecast come out that brought us up to 4.9. Obviously that's been driven by consumer expenditure, but there's also government expenditure, whether it's local or federal government expenditure, that's driving that GDP growth. As a result of that consumer expenditure increasing, retail sales are up. And I think somewhere, not only is retail sales up from previous month, it's up from a previous year, and it's accelerating again. So obviously the last quarter, summer month was strong, and that's partly what's driven the GDP growth. But I think that the interesting comparison for me is not necessarily the connection of inflation or pricing with that of the inverse relationship it has with employment figures, which is what obviously the Phillips curves would suggest. And that's been debunked for a number of years. But I think it's how are consumers funding the retail expenditure. Now, one, of course, is the employment numbers, and employment prospects still remain relatively strong, albeit less, from a consumer perspective, less optimistic as it was about 2 or 3 months ago, but still relatively strong. And I think if you look at the jobless claim numbers, they're almost at a 9-month low. So that's also heading it. Unemployment rate, although the new numbers are going to come out on Friday, the last number we had was 3.8%, and that was stagnant. The expectation is it stays relatively low again. I think the other factor for looking at, and so the other factor with employment, of course, is wage, and wage increases have been slowing down. But, you look at recent hikes by the auto worker strikes, and that's how that's coming through. That's certainly going to change things a bit as well, and give more confidence, at least to consumers, that employment prospects are relatively, I'll use the word relatively, stable. I think the other factor, of course, is household debt, right, and household spending. And if you look at household debt, that has only been increasing over the last, I think it's the last 8, 9, 10 quarters. And if you compare that debt, where the biggest increase in that debt is coming from, it's coming on credit card debt. And then you have these high interest rates against that credit card debt, which is a risk. But then also, no surprise, you're seeing card delinquency rates increasing now as well. So, I think there are a number of factors here to be cautious about, and the Fed will have their hands full and trying to mitigate the economic growth. And I think Jerome Powell mentioned it at the economic luncheon in New York, that he was head fast on keeping the target and the commitment to the 2% inflation. But I think it's going to have to sacrifice further economic growth to achieve that. And I think that's where the balance for him is: how much of an economic growth will he have to sacrifice in order to get it under that, to get it down to the 2%. I think the other factor that they're concerned about, one last point, I think, is the core CPI, right? The headline number has been coming down. And in the last month, we have the CPI coming out on the 13th or 14th, I think. But the core CPI was higher than the headline CPI. I think the headline CPI was at 3.7%, and the core was at 4.1%. And that core has been higher than the headline. And so that's a bit of a concern, will be a concern for the Fed as well. So I think overall, I think there's headwinds, there's tailwinds, there's improvements that's been made as a result of the tightening of the monetary policies. But I think the easy disinflation is over. And I think now from a Truflation perspective and all the data that we're seeing, I think now the hard graft is needed to get the inflation under the 2%.
Very nice. Looks like we've got our CEO, Stefan Rust, live from New York. Stefan, before we throw to Cem, give us a quick update on the Truflation Nation.
Yeah, I mean, it was really interesting. I mean, Oliver sort of highlighted the economic situation pretty well, so I won't go into that too much. But the interesting thing that IMF just issued a report working together with their central banker buddies to say that inflation will be here for years. So inflation is not going away. And, number one, so much for transitory. Number two is, which is actually the reason why we set up Truflation in the first place. And then number two was the fact that they also are seeing the shining light in government spending as the way out of inflation by doing investments in green energy and governments taking investments into their hands versus the private sector. And then also sort of a lot more government spending and employments over there. So interesting to see where that goes and how this whole thing ends up. But across Truflation Nation, that I'll just leave it there, and maybe we come to sort of hand it a bit over to our guest speaker, and really excited to hear his thoughts on the situation.
Very nice. A nice segue to bring on our featured guest, and that is, of course, Cem Karsan of Kai Volatility Advisors. He formed Kai after about 2 decades of experience building industry-leading derivatives businesses, which include precision capital management, and he holds an MBA from Northwestern University's Kellogg School. That's just kind of the basics of Cem. He's known as a legendary investment advisor, and just one of these guys that you always want to get a take from. Cem, I know you're busy. You've got a hard out here in an hour, so I want to get you in right now. Thank you so much for coming on. We really appreciate it.
Oh, my pleasure. Thanks for having me, guys. I love the work you guys do, and I love the mission that you're on. I couldn't imagine a more important one right now. On this Fed day, it's become abundantly clear. We've been talking about it for years, about 3 years now, how this idea of transitory inflation is just flat out wrong. It is, we're at a structural regime change, we believe, and that's very much played out the last 3 years. I think when people think about inflation, they tend to use one word, one number. And the reality is that inflation is much more nuanced than that. And not just from a community by community or individual by individual. People, experience inflation very differently, but really and I really want to drive this point home today on a cyclical versus secular piece, on that piece. I think and I've talked about this quite a bit, but I just want to really lay this groundwork. We have been in a structurally deflationary environment for almost 30, 40 years, 35 years now. And ironically, the piece that people don't realize is that's actually because of a monetary policy driven regime, a Federal Reserve dominant cycle that's really driven money to capital as the solution to every market downturn, every cyclical downturn. We've responded with supply side economics, with monetary policy, which drives capital to money to capital itself, to wealthy individuals, to corporations. That's who borrows money. When we lower interest rates, people at the bottom do not get the benefit of that. People at the top do, and corporations do. That's a very, it's a great system. It's a capitalist-driven system. It's efficient. It drives other things, right? We send money to capital. Corporations are profit-seeking entities. They are going to compete and drive down their cost of production, and they are going to try and expand and grow new technologies. So that's created this, what I call a three-legged stool, the three-legged stool of deflation, which is globalization, technological development, right, and cheaper capital. So that itself makes things cheaper, right? And those three things are all tied to the same thing, ironically, which is cheaper capital itself. That could go on forever. That is an incredible. Again, it's providing more oxygen to the system. The problem is a natural system, a capitalistic system, is not one that is equal. It is an unequal system. Survival of the fittest means the fittest get, the best violin players get the best violins, in the words of Socrates. And the question is, should the best violin players get the best violins, or should the worst violin players get the best violins? And we live in a world where human beings believe in concepts of equality and justice and fairness. These are not natural constructs, believe it or not. But they're concepts that matter to us. In a natural system, if we keep providing the best violins, the best violin players are going to get better and better and better. And what happens to those that aren't good violin players? So this is a story as old as time. It's fairness, justice, equality versus output, GDP, survival of the fittest. This red-in-tooth system. And because we've been operating under a monetary policy-driven system, we've gotten to a very unequal place over 40 years. We've had 1.75% real GDP growth for almost 40 years, of which 0.75 of that has gone to the median. That means the 1%, more than half the real GDP has gone to the top 1%. More even concentrated to the 0.1%. And we now have gone from a 0.35 Gini coefficient, which is a measure of the stratification, the distribution of wealth in the developed world, to 0.45. Dramatic change. We're in line now with much of the emerging market world in terms of our equality measures. Now, again, we can all argue politically whether that's okay or whether that's not okay. But what matters is that people are in this system. And at some point throughout history, these things, the natural system takes things to more and more unequal points. And then we get our let them eat cake moment. And that can happen via revolution, or it can happen through the ballot box in a democracy. And starting about 10 years ago or 12 years ago now, we got Occupy Wall Street, and on the right, we got the Tea Party. All of these were about, hey, the system's broken, it's not working for us, broadly driven by the youth of two different sides of the political spectrum, but were the same thing, which was a populism, a drive of a desire to make things more fair. Importantly, stratification is not just wealthy versus poor. It is youth versus old. Because youth, by definition, when they come out of high school and college, are labor. They are the bottom of the stratification. And older people have generated income and have assets, and they become the top of that capital. They become wealthy. And so millennials on down have really been the ones who have been hurt the most through this expanding inequality. And generationally, eventually, that generation on down comes to political power. And that's what's happened. It's taken about 12 years. Every 4 years is a significant change in the political dynamics. Baby boomers are dying off. The next big demographic bubble, millennials, who have this different view, are coming into political dominance. And they feel the system is broken. It does not work for them. Many of them are at home still with mom and dad. Wealth creation and household formation are about at 40% of where baby boomers were at this point in their age. So there's an overwhelming political feeling on both sides, whether people believe whether they're poor white in West Virginia, ethnic in the cities of Chicago or wherever. Everybody has the same feeling that the system is broken and it has not worked for them. And that's what has led to the creation of Bernie Sanders and AOC and the moving of the left, but it's also what has created Donald Trump and the bringing of the right left as well. In terms of economic populism, the rusted out cities of middle America, that is a very populist message. And with populism comes protectionism, right? Because people are local and specific to countries. The reality is that capitalism is global. And we begin to get the unwinding of the three-legged deflationary stool, right? Because now globalization, which has been the story of the last 40 years, driven by cheaper capital, driven by monetary policy, is now going into deglobalization, is going into a protectionist mode where we are all competitive and not cooperative. And during periods like this, like we have seen in the past, think of the 1960s and the 70s, we got a reemergence, a strengthening of the Cold War, a beginning of a hot war in Vietnam, which is another expression of that. You start to see the closing down of borders and competition. You get resource scarcity and countries flexing their muscles more to compete, like we saw with the OPEC crisis in the 70s. So you see deglobalization during those periods, and that is what we're beginning to see now. And that is an incredibly, as you might imagine, think about how much deflation was exported from China in the last 40 years, and now we are starting to see an unwinding of a lot of those trends. So there goes one of the legs of the stool. Less capital going to corporations, so you see a slowdown in the boom that is Silicon Valley, that is a lot of the technological development, because there's just less funding and less oxygen to let things grow. Again, I would argue that Amazon, Uber, Tesla, a lot of these companies wouldn't exist if we hadn't had a 0% interest rate regime for essentially 25 years that allow companies to not make years focus on ideas and technology. So here we are now pulling that oxygen out of the system and that money out of the system, and that is leading to a slowdown in technological development and growth, and that is also ultimately, obviously, increasing the cost of doing business and refinancing as well. So this three-legged, structural, secularly deflationary picture has now turned in reverse, and that is something that, as long as a people we are going to focus on populism and inequality and the problems of the last 40 years and trying to fix those issues, we are here to stay. And that is tied to a generational reality of our shared history globally and what this now voting, these people, the millennials on down, how they feel and what they need. And that is not going away. And I think that's the most critical thing to understand. We are trying to now battle that. Now let's go to the cyclical. We're now trying to battle that secular inflationary force, the increased labor rights, the increased protectionism, and the increased all the things we've talked about with monetary policy and cyclical forces. And not surprisingly, it's not working very well, much like it did in the 70s. Eventually, you can hit the economy enough, you can raise interest rates enough, you can use cyclical forces to affect in the short term these secular forces, but they are underneath all of this and they will reemerge. They're a underlying force. And that is why we're seeing a difference between core inflation, some of these other cyclical, these other cyclical factors as well. And that will continue to be the case, much like it was in the 70s. You will see recessions, you will see inflation kind of come down in terms of the headline numbers. But eventually, when the Fed turns around and now stops fighting the structurally inflationary forces for a second, that inflationary picture will come back in spades. It is a very demand push economy. And again, all the fiscal spending that's going on is a reflection of that. But I'll leave it there for now. I have a lot more to say, but I'll let other people talk for a bit.
Yeah. No, that was an incredible starting point. It jumps off perfectly from what Oliver was saying with regard to the choices the Fed has to make in terms of policy and the implications of that policy. But as you were talking, my very first thought was kind of an old 101 philosophy, maybe even econ course, where the professor just began by saying, humanity's natural state is poverty, and the rest is kind of up to us. But brief kind of identification here. You're listening to Truflation Spaces, featuring economist and investor Cem Karsan. We're discussing the FOMC today and what they're fixing to do later with regard to rates. We do want your opinions. We want your thoughts. You can at us on X here in the thread and ask a question that way, or chime in and request to speak, and we'll move you to the front of the line so you can ask Cem all your questions. We also have an all-star panel here. Stefan, what's your reaction to Cem kind of laying it all out there?
No, Cem, really, really resonates what you're saying, right? I really think that we're in this phase where people haven't realized the benefits that we've gained from all of this deglobalization and globalization, right? And now the deglobalization, what sort of inflationary impact is that going to have on the system? It's going to be significant, right? And then the demonization, I call it, of technology that you just emphasized as well, right? So we're now equally taking that into, we won't even start innovating on AI because we don't know what the costs of the burden and that drive to inequality or might lead to, right? And so I think all of those. How do you look at this, right? So on the one hand, we all, on a societal level, we look to equality. We want to be fair. We want to be nice to everybody. Everybody should have their fair share of the pie. Yet on the flip side, when we look at the most popular form of entertainment being sports, there, it's all about having the best team with the best players. Win is over everything, right? You just win or lose. Nothing else matters. How do you play those two societal, contradictions against each other? And we're ruthless. If you played 2 bad games or 3 bad games, you're out. You're slammed. The media honks down on you. But yet, in society, if you're mean to one employee or something went wrong or you said the wrong word, it's taken totally out of proportion and made you out to be a demon, right? I mean, so how do you play those two societal elements against each other?
Yeah, I mean, the truth of the matter is there's no right answer, right? There's a reason that we've been, that Socrates was talking about these things, 3,000 years ago, right? The reality is, in my opinion, that there is a natural system of survival of the fittest, raw and tooth and claw, and it's not fair. It is, what's the first thing a child says? It's not fair, and mom and dad say, well, life isn't fair. Life is not fair. Now, that said, we are human beings, and actually physiologically, part of the things that differentiate us from the animal world is that we have a bigger frontal cortex, and that means we have a better sense of self, or we define ourselves we separate ourselves from the world and help that allows us to manage the world and do incredible things, but at the same time that creates an ego and a sense of self. And when I am an individual and you are an individual, guess what? There must be some type of equality or fairness or justice in this system. And so these two things they're not things that are going away. There's not a right answer. The only reality is that we live together and have to balance, the needs of one another societally in the context of a system that is really, a world of entropy and a world of survival. Yeah. It's a very raw world, and those lead. If we want to maximize GDP or maximize technological development, a capitalist system that's raw and tooth, and claw is the most productive. If that's what we're maximizing to, but is that what we're maximizing to? If we're instead maximizing to median outcomes, right? To how is the average person doing, right? Not the average, but the median, right? The most number of people are doing the most well. That's a very different system. And that is not going to maximize to GDP. That is not going to maximize GDP. That's not going to maximize the average. And that will slow things down and make them more inefficient. But guess what? Maybe that's what we want. Maybe we just want more people to be more happy, all right? But there are costs to that, right? As a society, there's less technological development. There's less, and there's more inflation. There's other things that need to come along with that. And I think that's the big 30,000 foot picture. There are probably better, more efficient ways to accomplish those two goals together, but they're complicated, and they're definitely not populist, and they're definitely not purely capitalist. But generally, I think a capitalist system with kind of thoughtful rebalancing to prioritize medians is probably the right answer. But again, that's not a place where our political systems tend to go.
How do you feel? I mean, ultimately, you've been in business. We've all sort of taken risks, and as a result, taking risks requires a reward at the end, right? You want to get the reward. Otherwise, you're just taking the risk for the sense of a dopamine hit, maybe, or a serotonin hit. How do we incentivize systems so that we're not giving government bureaucrats that have never taken any risk, have looked for consensus in everything they do all the time, and give them all the rights to decide the future of our lives and the world, versus changing the incentives so that we drive we incentivize clean tech. We create private techpreneurs to go and build the best technology possible. And there it is, survival of the fittest. In the startup world, it is bloody hard, right? It is super tough. You're fighting every single day until you hit that product market fit. And then once you've hit that, you still need to fight every single day to get it to the next level and get market adoption. You can't just write a law, everybody take this product, and everybody has to take it, and you have to take it 3 times over the course of the next year. You don't have that ability to do that anymore. How do we incentivize the systems to have the right kind of models so that we can see that come to fruition again?
Yeah, look, we don't need to overthink this. It's all about incentives, right? And politicians 100. Do what they do. The politicians do what they do, not because they are stupid or bureaucratic. It's because they are incentivized to do this. Do you think Donald Trump is going out and arguing his arguments because that's what he thinks? No, he is doing it because he can get votes, and there's a political support for these things, and they play to those political realities. So the question really is, why are these things politically popular? How can we manage that? It goes even to the idea of is democracy where the average person is thinking about themselves? Is that and not thinking about the bigger picture, right? Is that really the system that is going to drive the best outcomes? Again, most people would argue it's the least bad of all the systems because of the threats of autocracy, right? But the reality is it's a messy system with all kinds of fraught incentives, and there's no good answer. But it is important to understand, to back up, right? Because again, it's important to understand and educate, right, people about how the system really works and what is actually going on. That's what we're doing here,
Yep.
right? So people can make more informed decisions. So policymakers can make more informed decisions, and so we can do better as a society.
One thing that a lot of people bring up is the fact it's not. We always talk about the U.S. and the U.S. economy, but it's not only. This is happening everywhere around the world. Governments like Japan, like Europe, Germany, France, England, or China even, right? Every economy is having a lot of challenges. They're all in debt. They're all overextending. They're all playing to this equality card. The argument is, we've got in the US, we've got the best system, right? So, and I would argue that is actually, having traveled to most countries, that is actually most probably pretty true, other than small countries like maybe a Norway or a Switzerland, where it's extremely federated, it's very distributed, but it is also still very equal and balanced. Are we good to say that the U.S. is the best system? We've got it all covered. We'll find our way, and the solution will be coming from the U.S. and the brains that are here and the bronze that are here, or is it Ray Dalio's sort of scenario where China is the next global power? Although right now I'd say that doesn't really look like that.
Yeah, I mean, look, the U.S. is the most capitalist system, and the most capitalist system is the thing that most closely, in my opinion, matches incentives of the natural world, right? And that creates a more efficient, optimal system. Now that eventually does create, like I said, a more unequal system over time. The reality is, it's not about better or worse as much right now. Let's get back down to reality. It's a situation of power. The U.S. has dramatically more power than any other entity in the world, despite what you may hear, both in terms of economic, military, rule of law. Like, we can go on and on about the systems here, and that means our system has become and is the system of the current day, right? Now, that won't last necessarily forever. There will be a more optimal system. There are problems, flaws within the system, in the sense that we tend to. It's meant for the founding fathers of the United States made a system that was not optimal in terms of passing laws and changing things, as we're very slow to change. It is a system that is meant to last longer and to be more stable, to avoid revolution, and also the entropy and power of the strong becoming too powerful in a system. Hence all the checks and balances, and why we need a crisis whenever we want to make a major change, right? This has been by creating the Federal Reserve. We've created a system where we're removing crises and smoothing the business cycle. The founding fathers of the U.S. would not have approved of something like the Federal Reserve because there's too much power in one entity there. And by smoothing the business cycle, we have removed crisis from the system here, and that has actually created major standstill and change here in policy, movement. There's a reason we haven't had a constitutional amendment in all these years, right? We haven't had political, reaffirmation of the structures of government because we haven't had crisis, and without crisis, nothing happens in the government. So that structurally is a problem here in the United States, and we're seeing a decay and entropy of a political system that was really not meant to necessarily go as long a periods without recycling and re-energizing and reinvigorating, the structures within the democracy. And I think that's a lot of the problem we've seen. I think people underestimate the knock-on effects of creating a system that is run by an extra governmental bunch of technocrats, right, to smooth the economic cycle. There is a natural state of things, clearing out the brush fire, right? The underbrush, it makes it so that the whole forest doesn't burn down over time. We have not done that for quite some time. And the Fed put has seen to it that every crisis is dealt with quickly and handily. And my view is that that's likely to change here. That we are likely to get a bigger forest fire because we haven't cleared the underbrush for some time, and that will lead to political change. That will lead to, and it already is, lead to policy structural changes that are actually healthy and necessary. But again, I think that the reality is, if we really want to fix this and make sure this system lasts longer, there are some real changes that need to happen and checks and balances on the Federal Reserve itself.
Wow. You are listening to Truflation Spaces with special guest Cem Karsan of Kai Volatility. If you want to follow more of his work, you can reach him out at www.kaivolatility.com. We've got some questions for you, Cem, on the thread here, and hopefully I will not knock us all off as I attempt to do this. Let's see. Hot Potato Trader would love to hear Cem's opinion of option flows for the rest of the year. Let's see. Thank you for special guest. I love that your handle is Cem Karsan, by the way, for drawing attention to the movement from globalization to protectionism. Cem, do you see the big gamma move you talked about coming after Fed meeting today? Okay, so let's just start with these two. They'd love to hear your take on the on option flows for the rest of the year. And do you see the big gamma move you talked about coming after the Fed today, Cem?
Yeah, so we're going to go from macro, right, and what's happening from a macro perspective down to very micro. But that's what we do. That's part of why, and that's what you need to do, I think, to manage markets and to do things. Really understand the bigger picture and the slower moving cycles, but also these kind of day-to-day structural market microstructure. So to answer that question, there are structural flows that happen. It's a machine, right? The market is really a machine, and you need to think about it in that way. The system is such that certain momentum factors exist. Mike Green has talked about passive and the reinvestment that happens there broadly as a function of just economic growth and individuals reinvesting their money into the system. That happens at baseline and is always going, but really at very discrete moments, meaning monthly, quarterly, annual, we get the reinvestment of collateral of the increase in asset values that happen. And that, with the market up 10% or so for the year, the whole equity market is about $100 trillion globally. That is a $10 trillion increase in collateral for the year. Now, not all of that gets invested, like I said, at the beginning of the year. Some of that is monthly, some of that is quarterly, but a significant amount, call it, let's say, 15%, is reinvested at the beginning of the year. And that's just the equity market, all the private equity and venture capital and everything else that's tied to the market also happens at a slower kind of lagged interval. So first of the year is an important year for, if the markets are down like they were last year, the end of the year tends to be a bit kind of a weak period because there's collateral decollateralization in the market. Funds are closing down, investments shutting down. First of the year, in years where the market's up and the market's done well, is the opposite. And again, in the context of a $10 trillion increase in collateral, we're just waving our hands at these numbers. That's a $1.5 trillion, right, increase in investment in collateralization that you could put to work for risk. Now, the average daily amount that moves markets is incredibly small, given that it's a $100 trillion equity world. It only takes about 75, 50 to 100 billion dollars incrementally to move markets. So when you see the market move 1% in a day, which it's been doing on average, right? 1% of 100 trillion is $1 trillion, but that move is actually happening more because of the $50 billion, right? Much smaller amount of the capital moving and changing hands. Think of it like a venture capital deal where they only, they release 5% of the float, and it prices at a certain higher price, and all of the company gets valued at $1 billion. That's not necessarily, we can argue whether that's the real value or not, but there's just a very small amount of shares changing hands. And so in the context of $1.5 trillion going to work on Jan 1, people know that's coming at the end of the year. If the market's up, and that's part of why the Santa Claus rally the last 2 weeks of the year and the first 2 weeks of the year, the January effect, are so powerful. They are a function of that. Most years the market's up. Most year there's reinvestment, and entities front run that, as well as once it comes in, it pushes the market higher. That is the most profitable 4 weeks, month of the year by far in terms of winning percentage. And that's not a coincidence, and that's a function of structural flows like this. This is not about, is there inflation, is there not inflation, is what's happening to the world, and is this survival? But this is about, there are some buyers that are coming in that is structurally have to buy as a function of momentum and reinvestment there. And so that's coming this year, as long as we're still up by the time we get to December. Now, there are other structural flows that people need to understand. This is another underpinning of seasonality. I've really talked a lot about these Vana and charm flows. So there's a decay to risk. The market naturally is structured where there is a left tail that everybody is long the market. And market structure-wise, there are derivatives that skew in the market where there's a carry trade essentially in the market where you can sell assets that hedge the downside and buy assets for the upside, right? And do it on a very different risk return profile. The cost of hedging is very high. That distribution of the market, right, with a fat left tail, right distributed, really leads to a buyback of stock every day that the tail does not pass. And that is much like a carry trade. That's a profitable trade. The market goes nowhere. So structurally, it has to be monetized every day. And that buying back doesn't happen linearly either. That happens as a function of all the structured products and all the hedging and all the instruments that exist out there. And they don't get issued every minute or every hour. The majority of these products are done at discrete expirations at monthly intervals. And we know when those OPEX cycles are, and they're more exaggerated at the end of quarters again. And guess what the two biggest expirations are all year? The ones that are out there as leaps for years and years, and structured products are tied to end of the year, right? So you have these December OPEX and January OPEX on the single names that have the biggest amount of structured products tied to them and derivatives flow. And the decay of those, that Vana and Charm flow, is particularly strong at the end of the year. And it's accelerated because we have more holidays, significantly more holidays at the end of the year, with Thanksgiving in the US and Christmas, and not just holidays on the calendar, but days around them where there's much less volume weighted time, I call about 30% less volume weighted time at the end of the year. And that just accelerates these flows. So it really starts in November. And here we are in November, right? Because we're entering this period into Nova OPEX, which still has some Vana Charm support. And then we get into accelerated, and the window of weakness I talk about after OPEXs, where there's less support, we have Thanksgiving, an acceleration of that period. And then we get into, again, a very positive December period and all those flows, and then end of the year. So, there's a reason I've been putting on the calendar circle November 1st to November 3rd. It's a very important structural time for positive flows. There's a reason I've been saying be careful until then because of issuance from the Fed, from the Treasury and whatnot. But my view is not only at the time when structural flows are coming back in a meaningful way into this November, December period, not only are those coming, but at that same moment, we're going into a Fed meeting where the markets pulled back. There's some global, there's geopolitical conflict. There's all kinds of reasons for the Fed, like you mentioned at the top of this, to also pause and stop at the end of the year. There's also people need to have more money on their books at the end of the year so you can get real risks at the end of the year if things continue to go down. So my belief is that the Fed is going to pause here, as most people do, but also I think dot plots will look, given how bad the actual the inflationary picture has been the last month and a half relative to expectations, I actually think the dot plot's not going to look that bad. And on top of that, I think Treasury, as I spoke about a couple of weeks ago, now we're seeing is going to pull back on issuance a little bit and shorten the duration a bit, which seems to be the case, not dramatically, but enough to change the balance of power enough where I do think we'll get a positive seasonal period here into the end of the year, despite what we've seen up until this period.
Excellent. You are listening to Truflation Spaces, special FOMC edition with Cem Karsan, the great Cem Karsan, who's putting on a clinic here: philosophy, politics, micro, macro, you name it. They're going to ask him baseball questions and who's going to be traded next. We've got a couple other, we have a whole bunch in the queue here, but we've got a hard out in about 14 or so minutes. From Bob's Your Uncle, Cem, views on U.S. mid-market banking balance sheet issues, SVB, First Republic, for example, and whether Fed will extend BTFP program. Second one from Palo Verde. You might have answered this one. November 1st, with the window closing and positive flows coming on Friday, do you see the below 41.25 pain trade back on the table, given its FOMC day? Anyway, we'll start with those. Go ahead.
Yeah. So first things, I'll answer that first question. In terms of the banking
BTFP
issues, that is a reflexive. It's a reflexive trade. The reality is there is so much. Banks themselves, by definition, are leveraged entities with a tail. If their assets mark down, then they go out of business. They're just too leveraged, and that's true for all banks. That is why the U.S. government has backed the big ones, right? And so whether or not those banks have ultimately go out of business or don't is a function of capital markets themselves. It's a big loop. If markets choose to, especially in this world where, if a weakness begets more capital being pulled out of those banks, you can get a panic much more easily than you could in other times due to kind of social media and how connected we all are. Not to mention the amount of speculation there can be and how easy it is to speculate with leverage these days. I think the tail on those entities, those regional banks in particular, is not tenable. Does that mean they're going down tomorrow or the next month or even the next year? No. That means there's just a really, if you're quote unquote investing and not trading those in those entities, you are exposed to a likely scenario where at some point, you're in big trouble in this type of market environment. That said, if as long as markets hang in here at the end of the year, it might be a good trade to be long those entities, right? To take that risk with a stop during these periods. But my view is ultimately the heads will come home to roost again. That is not an issue that's going away. We have not really resolved the issue. We've only put a Band-Aid over it. There are just too many structural issues. So I would leave that there. But I would expect at some point, yes, that we will see a reemergence of the crisis from Feb March of this year in some form or another, but it will be in the next market downturn. All right, so back to the last question, flows. Again, I think I kind of addressed this, head on, but to give a little bit more nuance, in terms of levels. Look, the most important piece is where are we? As we get towards this end of the year piece, where are we? And it's a probability story. It's not just an up down story, right? It's conditional. So if this market, if issuance continues to overwhelm some of the flows, which I think we're entering a period where that's less likely here. But if it does to a point where it takes the market, unched on the year is about 3850 in the S&P. If it took us within a stone's throw of that, 4,000 or below, a lot of this end of the year structural reinvestment would be significantly less. A, and B, some of the other flows will be will accelerate potentially the other way. So there is still the possibility always that in a situation where the market doesn't get supported, that the momentum can go the other way. My view of why this is likely to not be the case is because there's a bunch of decay to skew in this Vonage Charm buyback, and at balance we are still up 10% at this point. So there's a cushion. This market would really have to decline in this meaningful way. I use the term time is not a bear's friend, particularly in this environment. Given that we're up 10%, given that these flows are coming, tie goes to the runner. If this market continues to go sideways or not go down with any meaningful speed, the net reaction will be higher. And I think that's the important thing to understand, that ultimately the probabilities point to a significant push here as we go further and further into the end of the year. And in the absence of a down move, you should expect a meaningful push up in markets during this period. And if by chance we do get some help from the Fed and the Treasury, which again we're already seeing signs of, even if it's just marginal, that can really push, lean on the scale a bit. So it's a game of probabilities, a game of distributions, and the probabilities point strongly towards support and strength into the end of the year. But again, it's reflexive. So if the market were to in the next 5 days drop 5%, that itself would be, again, we're not quite to the end of the year yet, and that would diminish the strength and force of the end of the year rally itself. So very important window. It could very well be a place with event vol decaying off, some positive speak and some positive numbers here. Dot plots from the Fed could be very meaningful today, and really as we go into early next week, a push up I would not fade. Again, a momentum game at this point, and so the more positive we get here and the more time passes, the more bullish you want to be.
Fascinating. In the final minutes here, I wanted to selfishly ask your take on Cem, on crypto and specifically DeFi and the phenomenon there. I know that TradFi guys and gals have been dipping their toes here and there, but the general sentiment seems to be kind of bearish, at least in the short term, but maybe bullish in the longer term, kind of seeing it as the future. Do you have any definite opinions on crypto / DeFi?
Yeah, I think there's no doubt in my mind that blockchain itself and DeFi in that regard are the future. Whether crypto, as and from a currency perspective, is the future, I have significant doubts. And that really comes down to, again, a philosophical view that money is a vessel of power, and all successful currencies since the beginning of time have had a sponsor, have had a powerful sponsor, kings, queens, governments, to underpin them. And although it is a wonderful idea of decentralized power, the world does not work in decentralized power, right? And and it is an ideal that makes sense for millennials on down, right? Given what they've gone through and how stratification, I mean, the creation of crypto is a reflection of this wealth inequality that monetary policy has driven globally, and the feeling that the system is broken and unfair. That said, it is very idealistic, and when you come to the realities of the situation, the U.S. government, the Chinese government, all the entities who have their own currencies and benefit from them, none more than the U.S. government, will not at some point allow for decentralized money and power. Will there be a digital dollar? Yes. Will blockchain a critical, important development, and will it underpin society's technological development for decades and centuries to come? I do believe that, but I don't think crypto is the answer. Now, that said, there is going to be, at the end of the day, millennials are the ones that are coming to power. And, they are the one with the political voting blocks, and they have the ability to drive, what millennials on down want is what you want to be invested in. And so in the short term narrative, not to mention all of the, all of the issues with fiat and the Fed's weakening position relative to global realities, makes it such that hard assets are very desirable. I've been very vocal about gold lately, and I'm not a gold bug, but lately, I mean, in the last year or so, commodities exposure. People who follow me have been have really heard of how strongly I feel about that in a world where there is now a energy put in the business via OPEC and other entities. True for most commodities. The more centralized they are, the more you want to be allocated to them. I mean, centralized to certain governments and entities that have power. That is an important trend, and Bitcoin does benefit to that to some extent. So there are narrative trends and there are structural trends that benefit the realities of a Bitcoin. But if we were talking about big picture, I'm less crypto. Philosophically, I don't think crypto will survive in the long run. I do think it will. The money for it will eventually divert to blockchain and DeFi businesses that will be very successful over time.
Wow. Cannot thank you enough. Go ahead, Stefan.
Yeah, just interesting on that note, right? I mean, I feel that in contrast, though, that crypto is actually extremely merit-driven, right? It's pretty ruthless. There are no safeguards. It is highly competitive, yet you also have a lot of volatility, which reflects that. You have a lot of scammers, which come into that, which you have in every industry. But just either way, I think it is far more of a reflection of the natural element that you brought up right at the beginning on this Spaces, Cem, where we spoke about, we want everything to be equal. No, by nature, we're built in this Darwinistic fashion. And I feel that crypto at the moment, left at its reins, is actually very Darwinistic. The biggest will survive, the strongest, the fittest, the ones with the most resources, the ones doing the best product that appeals to people. And so I see that as actually being, and the risk reward ratio is there, right? I mean, I take a risk in a crypto asset, and if it goes well, and if I'm an entrepreneur in that space, I can actually monetize that and commercialize on that. So I do feel that is, I mean, the question is, will the existing political landscape allow that to run away? And definitely the financial landscape feels very threatened by it.
Yeah, it's a financial market at the end of the day, and I think that can drive. And again, it's technological development, capital. I mean, it is much like all business. It is a capital-driven endeavor, and there's less regulation, I guess, to your point. So that is better. For advancement, and I agree with you on all that. But we're essentially creating a system. The whole point of the ledger is to make it more equal, right, and to make it more fair, right. And at the end of the day, that is unfortunately in a system where
it is not equal, entities will not, forfeit their power, primarily governments and entities. I mean, I cannot stress enough that the overwhelming majority of the United States power is the exorbitant privilege of the U.S. dollar, or at least that's the expression of our power, right? And without that, we have very little that we can do to control kind of world outcomes. It's a reflection of other powers, to be clear. But if the U.S. was to at any point forego the exorbitant privilege of the U.S. dollar, the whole system would fall apart, and we know that, right? And other countries throughout time know that and understand the power of that. So I just think it's an intractable, situation not to have a powerful sponsor behind you. Now, that said, America happened, right? America was a move away from power and powerful entities controlling, right? That was the whole idea. But there was a vacuum into which we could move. There was a new world, right? And so there was a kind of a way to build power, and there was natural resource power, all kinds of other things in the United States that allowed that to America for that to develop. If there was some situation like that, like Bitcoin was taken to Mars and develop new colony, right? And that was, there was all kinds of natural resources and wealth that allowed it to then foster different story, and the whole world can change. But in a closed system where power is power, I'm very skeptical from a philosophical perspective. Again, it doesn't mean it's not bad trade in the short to medium term, and again, it doesn't mean I don't believe in the powerful. The realities of blockchain itself and what that will likely do in changing kind of the world going forward.
Fascinating stuff. Unbelievable talk here, Cem. We've dragged you all over the place. We still have like 17 people in the queue, but I've definitely overstayed our welcome here with you, and it's time to say thanks, Cem. How can we find your work and kind of follow you?
Obviously at Cem_Karsan here, KaiVolatility.com/news. If you go there, you can subscribe to kind of our thoughts, which, we send something out about weekly. If we do any presentations or write-ups, that you'll get them through there, and you can access all of our work there. Otherwise, again, just you can always, if you're interested as an investor, we have three hedge funds, and we do non-correlated investment broadly, both on an absolute return and hedging basis, and have been around for quite some time. So just reach out to us at KaiVolatility.com. Thank you.
Really, really appreciate all of your time and your insights. Thanks, everyone. Thanks to our CEO, our head of product, and everybody else who participated. We're back again in about 2 weeks for the BLS CPI analysis. We should have some promos coming up very, very soon. Thank you, everyone. We really appreciate it, and we'll see you next time.